When the stock market takes a huge dive, the headlines are all about panic and selling. But what if the real story, the interesting one, is hidden inside the data? Today, we're going to unpack a major market sell-off, and we're going to find the hidden signals that most people miss. Let's get into it.
So first, let's just wrap our heads around what actually happened. It was a day that was pretty much defined by one very large, very red number. This, negative 961.42. This was the number flashing across screens everywhere. It represents the Sensex's dramatic single-day drop. It's the kind of number that just grabs your attention and puts everybody on edge. But what does it really mean when you put it in context? Well, this slide helps put that big, scary number into perspective. The Sensex fell about 1.17%, and the Nifty 50 dropped 1.25%. So this wasn't just some minor little dip, right? This was a significant, broad sell-off that wiped out recent gains and broke through some really key levels for the first time in almost a month. Okay, so that leads us to the million-dollar question. Why? What on earth caused this plunge? To figure that out, we need to look at both the technical charts and the overall mood of the market.
So, if you were looking at the trading charts, the day formed what traders call a long bearish candle. Now that sounds complicated, but it's actually pretty simple. All it means is the market opened up, and then sellers just took total control for the rest of the day, pushing prices lower and lower right up until the closing bell. It's basically a picture of a day dominated by negativity. And that negative feeling wasn't just coming from one place. Nope, it was a combination of different pressures all hitting the market at the same time. It was kind of a perfect storm that really fueled this sell-off.
And here's the breakdown of that pressure. You had weak signals coming in from international markets. Some growing geopolitical worries were spooking investors, and then, boom, heavy, concentrated selling in huge domestic sectors like auto, realty, and financials. When these big guys start to bleed, they tend to pull the whole market right down with them. But here, this is where the story gets a lot more interesting, because even on a day of such widespread losses, there were these little pockets of the market that actually held their ground, and they give us a much more complete picture of what was really going on.
It's so easy to get lost in that sea of red on a day like this. But the real analysis, the smart analysis, starts when you look for the exceptions, those little green shoots. You have to ask, where was the money going when it was leaving almost everywhere else?
And this chart just illustrates that contrast perfectly. Look on the left. You see the massive hit that auto and realty took. In the middle, there's the overall Nifty average. But then look all the way to the right. IT and media, they actually finished the day in the green. It's a small gain, sure, but on a day like this, just staying afloat is a huge sign of underlying strength. So this brings us to the really exciting part. How can we use the data from a day of chaos like this to spot potential momentum for the future? Well, to do that, we need to understand one key concept. And that concept is open interest, or just OI. Think of it like this. It's the total number of bets or contracts that traders have open on a stock's future price. So when you see a huge jump in open interest, at the same time the price is moving, it's like watching a huge crowd of traders all rushing to make the exact same bet. It's a massive signal of strong conviction. Let's see how this actually plays out with a real example. So first up, we have Polycab India, which was flashing a really positive or bullish signal on a day when pretty much everything else was down. Just look at this data. The price went up almost 1.7%, which is impressive on its own, but here's the kicker. At the exact same time, its open interest surged by almost 20%. This powerful combination is what traders call a long buildup, and it suggests that a lot of people are confidently betting that this stock's price is going to keep on rising. All right, next, let's take a look at Oil India. It showed a similar trend, but maybe even a stronger one. Here we go again. The price jumped over 3.6%, while the open interest also saw a really big increase. That's another strong long buildup. But what's really crucial here is that it didn't just outperform the market, it outperformed its own sector. That's a textbook definition of what we call relative strength.
Now, open interest can also be a warning sign. It can signal weakness too. The data for Bond on Bank, for example, points to something very different, a potential for more downside.
So, with Bandai Bank, the price fell over 2%, but its open interest still spiked by over 10%. This is the exact opposite of what we just saw. It's called a short buildup, and it suggests that traders are piling in, betting that the stock's price is going to continue to fall. And that huge jump in delivery volume, it shows a ton of people are actively trading on that belief.
Okay, next up is Coal India. And here, the data suggests a more neutral, almost defensive strategy from investors. It's a different kind of story.
Now this is fascinating. The stock price was basically flat. It didn't really move. And yet, the open interest shot up over 13%. So what does that mean? Well, when you see a massive buildup of positions without a price change, it could mean investors are using it as a defensive play. They're parking their money in a stable, high-dividend stock while they wait for all the market uncertainty to just blow over.
And finally, let's look at Trent, a stock that was a real standout for its pure, simple, relative strength against the market's tide. The main takeaway here is really simple. On a day the Nifty got hammered, Trent was one of the very few stocks on the gainers list. It didn't just go up, it also maintained a really strong, bullish technical setup. Gaining ground when almost everybody else is losing it is one of the most powerful signs of an asset's real, underlying strength.
Okay, before we wrap this up, it's really important that we frame this whole analysis in the right way.
Look, everything we talked about today is designed to help you understand how market dynamics and data signals work. It is purely for educational purposes. Trading derivatives is incredibly risky, and this analysis is definitely not financial advice. You should always consult with a qualified professional before you make any investment decisions.
And that leaves us with one last question to think about. When the market's in chaos, the headline is always about the panic, about the fall. But as we've seen today, the more powerful story, the one that can actually help you, might just be hidden in the data, in those few stocks that defy the trend and show strength against the storm. Where you choose to focus, well, that can make all the difference.